again and welcome to our live webinar. And without further ado, let me hand the reins over to Mr. Li Yijie.
Thank you, Sri, for the introduction. Welcome, everyone, and thank you for spending your evening with us today as we walk you through how you can build your Forex trading plan, your very own plan, and how can AutoChartist help you to expedite the process or even supercharge that trading plan of yours. Right, before we begin, just to share a quick disclaimer that whatever we'll be sharing today is done with our due diligence. It does not constitute investment advice because it does not take into account your specific trading strategy. So should you wish to trade, do consult your very own investment analyst. So moving on from here, these are the questions that we will be covering, right? We will be sharing today, and some of these are on your mind. So maybe just really quick, type in the chat or in the question box which are the questions that you want to be answered today, or what are some of the questions that you have burning in your mind, right? And maybe after that we can spend more time to cover those topics, right? So just going to give it a real quick 5 seconds for you to key in whatever number that you like me to go deeper into. 5, 4, 3, 2, 1. Okay, moving on. So these are the contents that we will be covering today, right? We'll be talking about a trading plan. What does it constitute? What exactly is risk management? Because this term is thrown around quite widely, but what exactly does it constitute? Moving forward from that is also 3 key elements to building your trading plan. Thereafter, we will talk a bit about post-trade management. After you've placed your trade, what do you do? Do you just leave your trade running, or what else can you do to better manage your positions? And last but not least, using AutoChartist, how can you 10x your speed in identifying chart patterns? Now, chart patterns is going to be a crucial portion of today's presentation because it's going to be the third key element for you in your trading rule. Right, so first of all, we are going to cover what exactly is a trading plan. So over here, we are familiar with these 3 plans, right? Our work plan, fitness plan, and travel plan. Whenever we intend to travel or we intend to work out, these are the things that we set in place to tell us what we want to achieve. I think the favorite among the 3 would be our travel plan, right? I love to do that as well before I embark on a trip. So it tells me, it gives me an overview of what I can do, what I want to do, and it keeps me on track. So in the same way, that is what a trading plan is about, right? So we're going to cover specifically what it is, right? So trading plan is an A to Z of things you need to do for achieving an objective. So in this case of trading, it is being profitable. Secondly, it is a checklist of the conditions that has to be fulfilled before you go forward to take an action. And last but not least, it is a clear definition of the parameters within the strategy that you may have. So why is this important? Some of you may ask. Why is the trading plan important? It's important because it helps you to keep track of what strategy works and what do not, right? Because many new traders, when they begin, they hop from one strategy to the next without any clear way of identifying to them or indicating to them which actually works. When one strategy starts to become unprofitable, they just deem it to not work. But that's not true in most cases because trading is all about probability. So having a trading plan helps you to track which strategy works and which does not. It keeps you from trading inconsistently every time. I think for those of you who have started trading, either on a demo account or live, you would know this. Sometimes when you place a trade, you base it on your gut feel and you do not really have a specific strategy to follow. You just look out for one indicator. Perhaps it's a hearsay, perhaps it's a news, right, that caused you to trigger the trade. But having a trading plan ensures that you consistently follow a plan every single time. Last but not least, this is the most important. It manages your emotion in trading, or what is known as trader psychology. Now, this is a huge part in live trading. I think for people who have embarked in live trading, you would understand that some of the symptoms of trading psychology, for example, when you place in a trade, you set a stop loss and you realize that you're starting to lose, the trade is going against you, and you start to move your stop loss away from its initial point, thinking that the trade will eventually reverse, right? So these are just some traps of trader psychology which the trading plan will help you to overcome. So what does it comprise of, a trading plan, right? So a trading plan comprises of a position sizing, how much you should be putting into each trade. It tells you what are your entry rules, what must happen before you enter a trade, gives you the exit rules, right? So this is something that some of you may not know. Entry rule is something that is common, what are things you must see, but some may not be aware that actually there are exit rules as well, indications where you should be exiting the trade whether you are profitable or not. And last but not least, as we mentioned earlier, position management. What do you do after placing your trade? Okay, so on to risk management. Now, when we think about risk management, sometimes this question appears in our head, right? How much am I willing to risk per trade? So if this is one of the questions that you have in mind when thinking about risk management, then I'm here to share with you that it's a very dangerous thought, right? Because it is almost like taking a trip down to Marina Bay Sands, at the table asking yourself, how much are you willing to place each bet? But that's not the case with trading, right? With trading, there's always a methodology when deciding what is your risk. So if this is not the question that you should be asking, then what should you ask yourself before thinking about risk? The question you should be asking is, how much should I be risking per trade? Now, what's the difference? The difference is that there is a logical approach in calculating your risk. When you ask yourself, what should you risk? Then there is a methodology which you could follow to help you to calculate what are the risks that you should be taking per trade. Right, so I just have a quick question, sample question to sense out the audience tonight, what you are thinking and what do you view risk management as. So the question is this: you have a total balance of $50,000. You should aim to risk blank per trade. So A would be a fixed amount of 2,000 every time. B is whatever amount that you feel confident of. The more confident, the larger the amount. Or C, 1 to 2% of your account balance. Now I'm just going to give you some time to just key in your answers if you feel strongly about a certain answer. So A, B, or C. I repeat again, A is a fixed amount of 2,000 every time. B is whatever amount you feel confident of. The more confident, the larger the amount. And C, 1 to 2% of your account balance. Right. So by elimination, the answer is definitely not B, right? This is what we spoke about just now. It is not about how much you can risk or want to risk, but it's about how much you should risk. So actually the answer is C, 1 to 2% of your account balance. And this is actually logical in its approach. Now I'll share in the next slide why is that so. Because of this thing, the rationale of the law of large numbers. What this means is that as your sample size increases, the mean or the average gets closer to the expected outcome. So I put over there in bracket the secret that casino uses. So under that phrase, you would see an image of a roulette table, right? So for those of you who have seen a roulette table, you may think to yourself that there is an equal number of chances to win and lose if you place your bets either on red or on black. But if you observe carefully at the number 0, it is actually in green. And if the ball rolls into the 0 pocket, it is considered a loss as well. And so in that sense, when you calculate the probability, the casino actually has an advantage over you. And what happens is that over time, the casino does not bother in every single trade who wins or who loses, but they know that with a large amount of trades or large amount of bets being placed, right, eventually the outcome will be in their favor. So that's the law of large numbers. So what has that got to do with you? What has that got to do with traders, right? So in the same way, the more that we trade using the same strategy, the more the outcome will move towards the winning probability of this strategy. So I'll give you an example. If you have a strategy that have a 60% win rate, you will not be able to see this maybe in 10 trades, in 50 trades. Maybe as you move towards 100 trades, it becomes more prevalent. What is the winning ratio of this strategy? So that's what the law of large numbers is about, which is why you should risk only 1 to 2% of your account balance, because in this way you are able to afford to lose at least 100 times until you are completely out of funds, and you will allow the law of large number to come into play. Right? Because for many of us, what happens is that as we begin, right, we ask ourselves how much are we willing to lose per trade, and we end up risking 20%, 30%, some may be more conservative 10%. But even at a conservative 10%, if you think about the math, you can only place 10 losing trades. And even with a strategy of a win rate of 60%, you can have a row of 10 losses, right? So with that, your entire account balance will be wiped before you get to see any results. So which is why I put in 3 asterisks. We cannot see the results if we blow our account within a few trades. So that is key. That is something that I wish you guys remember and take home with you today. Risk management. Secondly would be risk to reward ratio. Every time we place money down on a trade, how we are looking to make more from it, right? But the question is, how much more? So this an example of reward to risk to reward ratio is like the image below of the mouse looking to get the cheese from the trap, right? Is the reward big enough for him to risk him getting the cheese? So I think when we think about risk reward ratio, that's kind of the concept that we want to be focusing on. So for example, the question that I have here, if I'm risking a total of 500 per trade, I should be looking at the possibility of making at least 750, right? So in terms of risk to reward ratio, that is above 1.5 times, right? Because if I'm risking 500 and I'm only looking to make 250 per trade, then it does not make sense anymore, because even if I have a 50-50% chance of winning, I would still end up losing because of this risk to reward ratio. And as I mentioned earlier, using the law of large numbers, at the end of the day, with a large enough number of trade, you will see your trade average out to the winning ratio. And so which is why this is also key for your consideration when you are thinking about risk management. So I'll just do a quick recap about risk management. Number one, we covered willing versus should, right? It is not about how much you're willing to risk per trade, it is how much you should be risking per trade. And then we talked about risking only 1 to 2% of your account balance, right? So this is because of the law of large numbers. As you place more trades, as you allow your account to stretch in terms of the number of trades, you will be able to see your winning probability play out. And last but not least, we spoke about risk to reward ratio. How much are you willing to risk in terms of the gains that you'll be getting? It's always wise to set a 1.5 times ratio. Right. So now we move on into 3 key elements of trading rules. Right. What are these 3 key elements? Number 1 would be trend. To find out what trend is the market currently in. Basically, there are 3 ways that the market can move: upwards, downwards, or in a sideways market, right? Generally, these are the only 3 ways that the market tend to move in. And so why is it so key to find out what trend is the market currently moving in? Because the market is made up of participants who are people, right? And humans tend to move in trends, tend to behave and act in trends as well. So I apologize for this typo that I do have. I do see that it is upwards. Downloads is supposed to be downwards. I do apologize for that. So back to what I was speaking about. Yes, it is important to find out because market tends to move in trends. That's because it mimics human behavior, human psychology. Second, we want to find out what are some key areas of value. So key areas of value in terms of support and resistance. So for those of you who are aware of technical analysis, you are familiar with the terms support and resistance, right? These are two key terms or two key levels that we are always interested in finding out, because it gives us information that we want to find out, like areas of value. And finally, triggers. So with all this in place, with trends in place, you've identified the value. Last but not least, you want to know what are the triggers, what are the confirmation signals before you decide to pull the trigger and place a trade. So I just want to preface my presentation by saying that the following slides are covering each component in a trend following perspective. So if you trade against the trend, this might not be applicable to you. The example I'm going to give, it's in the perspective of a trend following strategy. Right, so first, ways to identify a trend. So I found this really interesting image depicting, right, when why is the upward market or an optimist market called a bull market, and why a bear market represents a downward market. Because when a bull attacks, it swipes upwards, and when a bear attacks, it swipes downwards. And so for those of you who are new to this term, that's what a bull and bear market means. Bull means the market is moving upwards, it's trending in an upward direction, and when it's a bear market, it's a downwards bias, or it's pessimistic. So the first way you can go about to identify trend would be the use of exponential moving average. So this is what I usually advise when you are looking out for the trend of the overall market. You want to be looking at the trend of the time frame that is higher than what you are trading on. For example, if you're trading on a 1 hour chart, you want to be looking at a 4 hour chart and above. Or if you're trading on a 1 day time frame, maybe you want to look at a weekly time frame, so on and so forth. And I'll explain that a little bit more in detail later on. So what are some common exponential moving average numbers, right? So the common ones are 50, 100, and 200. These are common numbers that people apply to let them know what is the trend. So if the exponential moving average is pointing upwards and prices are above it, it is taken to be an uptrend, right? Simple enough. And the reverse is true. If the exponential moving average is pointing downwards and prices are below it, it is taken to be a downward trend. So that's the first way you can go about identifying the trend in a trending market. So in this instant, right, what do you think the trend is? Is it upward or downward? Right, it is actually a mixture of both. If you look towards the left side of the chart, the 3/4 of the chart, you will notice that it is an uptrend, and subsequently it moved into a downtrend because prices fell below the exponential moving average, and it began pointing downwards as well, right? So it is a mixture of both up and down trends. So this is key for you to know when looking out for trends. Now the second way that you can identify trends would be through the use of trend lines. Again, I would like to emphasize that the trend line should be established one time frame higher than the time frame that you're trading on, right? Whether is it if it's a 4 hour chart, then plot your time frame, plot your trend lines on a 1 day time frame chart, and so on. So how do you go about plotting a trend line? Basically, in the example, what I have is an uptrend. So an uptrend has a horizontal line, or a diagonal line rather, that connects three low points, three consecutive low points that forms a gradient that is pointing upwards, right? So it's quite straightforward. Once you see 3 points that may be connected in a plane, or what we call the line of best fit when we draw graphs, and the gradient of the line is pointing upwards, it is a uptrend. And the reverse is also true. When you are able to plot 3 consecutive high points connected by a plane that is sloping downwards, then you have what is known as a downtrend, right? So point 3 consecutive high points form a downward trend, right? So one question that you might have in mind is that why do I have to draw the trend lines, right? By looking at the charts, I will be able to tell that this is a uptrend even without the line in place. But of course, this is an ideal scenario, or a scenario where the trend is easily identified, but there are true cases in charts. When you're looking at live charts, the trends are not as easily identifiable, which is why a trend line is an extremely good visual aid for you to, at a glance, tell whether this chart you're looking at is currently in an uptrend or a downtrend, right? So imagine with me, you're looking across 15 to 20 charts. By the time you reach your 20th chart and you go back to your first one, you might have forgotten what you have established if the current point in which you are trading is an uptrend or downtrend, right? Which is why trend lines are so useful. So in this case, as I have explained, it is currently in an uptrend. So just quick recap, lesson 1, trade with the trend. Because unless a major reversal happens, as I mentioned, price will tend to follow the existing direction. This is because the market mimics human behavior and we tend to act in trends. So number 2, once the trend is identified, only look to take positions that follow the trend. So this is part 1, the first key element of your trading rule, right? Trend. Once you identify it's an uptrend, look only to take long positions. If it's a downtrend, look only to take short positions. That's the first key element. Second key element would be to find key areas of value. So this is where I'll dive a bit deeper into what support and resistance means. Right? Support and resistance, simply put, actually it is a level where prices tend to move towards and away from. Right? Support and resistance likewise. Why is that so? Because to understand the fundamentals of price action, why does that happen on charts? Because you have to be aware that behind the charts are buyers and sellers, and they tend to react at these particular points, and which is why if they either start to sell at a key resistance area or buy at a key support level, you'll always see prices moving towards and quickly away from it. So that is what we want to try to identify. Right, so in this example, we have a support resistance in a trending market. So one way you go about identifying that is by the use of ascending and descending channels. So the example on the right, in the image on the top, we have a descending channel, right? The reason why it's called descending channel is quite intuitive. You see two horizontal lines, or rather diagonal lines, sloping downwards. So how do you go about drawing a descending channel? Simply draw a trend line first, right? So in the first example, on the top image, you will connect 3 high points. Following that, what you will do is also connect the bottom points to form this channel. So depending on the slope of this channel, either it's pointing up or down, it will form the ascending or descending channel respectively. So ascending channel will be the one at the bottom. So how does this work? How does this help you to spot support and resistance, right? The lower band always acts as a support, and the resistance always acts as, the upper band always acts as a resistance. So the best way to think about support resistance is this. Think of support as an imaginary floor that prices cannot go below. And think of a resistance as an imaginary ceiling that prices cannot go above. So if you were to look at the images, one thing you will notice is that price seems to be bouncing back and forth the lines in which I have identified, or which I have drawn and plotted on the charts. Right? That is because the imaginary ceiling and floor stops the price from moving beyond that range. So which is why it is key for us to spot what are these levels. Next, using horizontal lines that connect 2 or more coinciding points on a chart, right? So if you see each horizontal line I've drawn, there are 2 or more red circles highlighting points which coincide in that plane, right? This is because I have identified these areas or this region where prices tend to move away from, right? The only exception to this rule of horizontal line would be if it's the highest and the lowest point, right? Because the highest point is by default a resistance and the lowest point is by default a support. So the way to look out for this is exactly the same as a channel. once you see that there are two or more coinciding points that can be joined using a horizontal plane, a horizontal line, the line of best fit, right? Then you would call it either a support or resistance. So that's the second way. Now the third way that is more commonly used would be what is known as a exponential moving average, right? So the exponential moving average, the popular ones are 50, 100, and 200 EMA. Now in this example, the blue line would be the 50 EMA, the red one 100 EMA, and the green 200 EMA. So how do you actually spot areas of value, support resistance, right? So if you observe on the left hand image, you notice that prices tend to move towards the red color line and bounce off it. If you were to look at the right hand image, you will notice price tend to move toward either the red or blue line and subsequently reverse from there, right? That is because in both instances, these moving averages have pointed out regions where buyers and sellers tend to react. So bear this in mind that support and resistance are not only does not only exist in a horizontal or diagonal plane, it can be dynamic, and in this case using an exponential moving average helps you to identify what these dynamic points are. Right, so just a quick recap again on what are areas of value, right? They are about identifying support and resistance points out of areas in the chart that prices tend to move towards and away from. Number two, it adds understanding that structure is one more layer of certainty in assessing future direction of the price movements. Right, so this is key because all that we're trying to do in our trading plan is formulate what is the best way or has the best certainty to tell us that it is likely to move in a certain direction, that prices are likely to move either up or down. Of course, there's no such thing as 100% certainty, but what we try to achieve through our trading plan or trading strategy is to find as many conforming factors as possible to point us to one single direction, so that when we place our trade, it is logical, it has a methodology behind it, and it is not at random, so that we can truly tell at the end of 100 trades whether this strategy works out or not. Right, so the third key element of your trading rule is to identify triggers or entry points. Right, so there are many types of triggers that are available. For the sake of today's presentation, I will only be covering chart patterns. Now, there are a list of so many chart patterns in the example below. Of course, I will not be covering every single one of them, but rest assured, all this information may be easily found online. What I need you to take note today is, of course, what chart patterns are there available, and thereafter, in the ones that I'm going to share, how do you effectively utilize them? Because it is not about just identifying them, but there are ways that you go about using these chart patterns. Otherwise, it is pointless to identify them. Right, so we move into the first chart pattern. What we have here is the pennant. So with every chart pattern, the thing to note is that there are certain characteristics that stand out, that make them what they are, right? So in this case of a pennant, you will notice that it is similar to a flag pattern. So if you want to see what a flag pattern look like, you can go ahead to drop that in Google and you'll be able to see how it looks like. Right, so it is similar, but the difference is that the pennant forms a sharp spike upwards or downwards. Right, it forms after a sharp spike upwards or downwards. Right, that is the pole. And instead of trending higher or lower, you notice that prices will start to trend sideways. So in the case of a flag pattern, what usually you would notice is that price will be pointed in a direction, right? The pattern of the flag, either upwards or downwards. But in the case of a pennant, it tends to trend sideways without any obvious direction. So this pattern is known as a continuation pattern. Now there are two broad categories of pattern. They are known as the continuation and reversal. So in this case, what continuation pattern means is simply this, that it continues with the existing trend. It continues with the overall trend after this pattern, right? So if you spot a pennant after a uptrend, right, usually price will continue to move upwards. If you spot a pennant after a downtrend, prices continue to move downward, right? So the reason for this pennant is that sometimes price will take a quick break, right, where buyers and sellers are uncertain of the direction. So that's where you see pauses in the market, because we all know that the market does not move in a straight line in a single direction. There are ebbs and flows to the market. There are periods of pauses and rests, right, before price continues to move in a certain direction. The next pattern I want to talk about is the wedge, right? So there are two kinds of wedge: the falling wedge and the rising wedge. Likewise, similar to the pennant, there are characteristics that make them uniquely wedge, right? So the characteristics is this: it is formed when prices are moving within a narrowing range that may be identified using two lines similar to the triangle as set in an angle, right? So what I'm trying to say is that you can notice that the opening of the pattern is wide and it slowly starts to narrow. Almost it's like if you extend it long enough, it will eventually meet. So that is what a narrowing range is about, right? It starts wide and smaller, right? So it will always be tilted either upwards or downwards, and based on that, right, it defines the falling or the rising wedge. So falling and rising, as the name suggests, it is quite intuitive. If you see a wedge that is pointing downwards, that would be the falling wedge. If you see a wedge pattern pointing upwards, that would be a rising wedge. So this pattern is different from a pennant in that it is a reversal pattern. So what this means is that prices usually break out in the opposite direction where the wedge is pointed, right? So when in a downtrend market, for example, you start to see a falling wedge. So what you got to be aware of is that it could be that prices will begin to break out in the opposite direction, and from that point onwards, there's a shift in market conditions. The trends move from down to up. Likewise, in the rising wedge, you can observe them in an uptrend market. You start to observe a narrowing range. You draw out your wedges, and what you need to take note of is that prices are likely, or start to look out for signs where prices break out in the opposite direction, because after that there tend to be a change in market condition and price will continue in the opposite direction, right? So that's for a wedge. So now we have a rectangle. Rectangle, as the name suggests, if you observe the pattern that has been identified other than the two vertical lines at the side, right, it looks like a rectangle. So what the characteristics of the rectangle is that it is formed using two horizontal lines. It connects the points of significant support and resistance. And if you recall me mentioning about a narrowing range, right, it happens in this fashion as well, not just diagonally in an angle, but it happens horizontally, where prices are moving in a significant direction, right, in this case in a downtrend manner, and you start to observe prices moving sideways, and each candlestick form are getting narrower. This signifies uncertainty in the market. This signifies a pause in the market, and this is usually where after which price tend to break out violently. So the rectangle shows, in terms of price action, a point of tug and war between buyers and sellers, which will ultimately result in one winner. So this is special. A rectangle is special in the sense that it is both a reversal and a continuation pattern. It has no specific one, so it is key to note which direction does prices tend to break out after this pattern, because either way is possible, right? So you really have to monitor closely for this. And in this case, price broke downward, so it is a continuation pattern. But it could very well break out in the opposite direction as well, right, which will make it a reversal pattern. Right, so we have a very popular and widely talked about pattern. This is known as the head and shoulders, and as the picture shows, it looks like a head and shoulder. There is a left shoulder, a head, and then a right shoulder, right? So there are four key components in this. Other than the left shoulder, head, and right shoulder, there's also a neck, line, right, where these 3 points are resting upon. So some key characteristics that define this pattern is that the two shoulders should be similar in height, right? So if you observe that one shoulder perhaps is as high as the head, then it would not be considered a head and a shoulder. Or if you observe that one shoulder is significantly lower, right, then it will not be considered a head and shoulders pattern. So it is quite specific in the sense that you have to observe that they are of similar height. Of course, the head being the highest peak or trough, resting on the horizontal neckline. Right, so this is a popular reversal pattern. So if you observe an uptrend, that would be followed by the formation of a head and shoulder, the top version. What happens after the breaking of the neckline is that prices would have reversed to the downside, forming a downtrend. Right, so the reverse is true as well. If prices start moving in the downtrend and you observe the formation of head and shoulder, bottom version, right, what happens is that after price breaks the neckline, you would see that it will begin to change its trend and move upwards, right? So this is a reversal pattern. Now for the last pattern that we have here, it's double top and bottom. There is of course another variation of this, which is the triple top and bottom, but you don't have to be too concerned about it. It is simply just one more peak or one more trough that forms the triple top and bottom. So the characteristics of this pattern is such that there are two specific high points that meet in a similar plane, right? Similar to the double bottom pattern, where two troughs meet or coincide, seem to be able to be connected by one horizontal line, right? So that is the double bottom pattern. So after bouncing off the near resistance or support is an indication that either buying or selling power is becoming exhausted. Right? Because you got to know that in each price action represents characteristics, behaviors, and patterns behind these prices, which are market participants. Right? So this is what's happening in terms of price action. Buying and selling power is respectively becoming exhausted when you observe this pattern. So this is known as a reversal pattern, similar to the head and shoulders. So it is usually spotted in a long-term trend. Once observing this pattern, you would usually see price reverse from there. So something key to take note of. Right. So spot the triggers. Lesson 3, the third key element of your trading rules. Right. First, we talked about trend. Then we identified key areas of value. And last but not least, we spotted the triggers in terms of chart patterns. Of course, there are various triggers. For the sake of today's presentation, we only covered chart patterns. I will explain a little bit more why. But if you are interested, the other variation of triggers are also known as indicators. Right? So for those who are interested, you can search it up. Technical indicators are also a form of triggers where you decide whether you should enter a trade or not. So the purpose of a trigger is to help you identify potential patterns that indicate either a bullish or bearish bias. Right? However, do bear in mind that this is not meant to be used in isolation, but in conjunction with the trend and key areas of value. Because what happens to many traders as they begin or they start exploring trading, right, they treat chart patterns or technical indicators as the holy grail, as the only thing that they need in order to make a decision to place a trade. But most cases these are not true, right, because it is a sequence or a series of events that gives you conforming evidence to tell you whether your postulation is correct or not. So these are the three key elements to your trading rules. So now I want to speak a little bit about post-trade management. Maybe some of you have heard this term before and you're curious, you're wondering, or even if you have not heard about this trade before, I'm sure for those who have been trading for some time, the question you might ask yourself is this: is there anything else that I can do after I've placed my trade? After I fired my order or my order has been has gone into the market, what else can I do? Right? So I've listed up the steps. from start to beginning. Now that you have worked out your risk to reward ratio, you identified the trend on your desired instrument, you marked out the key areas and key support and resistance using the most suitable tool, whether is it a trend line, exponential moving average, so on and so forth. You observe that triggers are indicating it is the right time to enter the trade, right? So you proceeded to enter the trade. What do you usually do now, right? So I'm going to continue, but for those of you who are interested to share, what do you usually do at this point? Feel free to go ahead and type it in the chat. I believe that many people in the audience today who are in can learn from your experience as well. So do feel free to just type in the chat any questions that you may have also at this point in time, and we'll proceed to answer it at the end of this session. All right, so moving on. There are a few tips that you can utilize when looking at post-trade management. You can reduce the amount of losses by being stopped out, right? Because one of the things that trader experience would be being stopped out, either prematurely or when price reverse against them. Number two would be to capture earnings even when your trade misses your take profit level, right? So this is extremely common. What happens is that you enter a trade, you set your stop loss, you set your take profit, prices are trending. For example, it is a long trade, you buy, and you observe that prices are so close to your take profit level, you decide to hold out, and the next thing you know, that price reversed and took out your stop loss level, right? So that usually results in a feeling of regret, thinking to yourself if you should have taken out the trade manually or earlier. And last but not least would be to capture earnings even when you are uncertain where to take profit, right? There are these times where you enter a trade and you have no idea how far can the market go, and you just want to see, and you just want to ride the trend, right? You just want to allow the trend to take you as far as you can to net as much profits as possible. But in cases like this, is there something that you could do to ensure that you are able to do this properly, right? So I've attached a quote by this very famous trader in trading and investing. It is not about how much you make, but about how much you do not lose, right? So moving on from here, so I've given the first scenario, right? You make a misjudgment. Your trade moves slightly in your favor and then suddenly dives the other way, triggering your stop loss as a result. So what can you do? I'm sure for many of you who have started trading, this is something that you have experienced, right? Initially, the trade is moving in your favor and suddenly it moves the other direction and trigger your stop loss. So what could you do in this case, right? So tip number one is to move your stop loss to your break-even point once your trade is sufficiently in the money, right? So this is a strategy that you can adopt once your trade has moved far enough in the money, for example 20 to 30 pips depending on your comfort level. You could proceed to pull your stop loss level to your entry point, such that even if price reverses, right, you would have exited the trade with a break even, right? But a word of caution is that moving it too early, moving your stop loss point too early, can cause your trade to be prematurely stopped out. So exercise this tip at your own discretion. Make sure that you are not merely 1 to 2 pips in the money before you move your stop loss level, because what can happen is that the volatility, temporal volatility of the market, or what you call the noise of the market, can take you out prematurely. Right, number two, this scenario is that your trade missed your take profit level by 5 pips, then dives to trigger your stop loss. A classic scenario, right? Your original profit of 40 pips became a loss of 20 pips, assuming that's where you set your stop loss, right? So what can you do in this scenario? So one of the solution is to trail your stop loss beyond your break-even point, right? What do I mean by this? In the first tip that I've given is to move your stop loss up to your break-even point or your entry point after your trade is sufficiently in the money. So now you have observed that beyond it being in the money, you realize that your trade is about to hit your take profit level, right? So this is a this is an exciting moment for you, right? Because any moment now, it can hit your take profit and you are out of the trade in the green. But what happens sometimes is that price reverses. So to prevent this from happening, what you could do is actually to move your stop loss point even further into profits, right? So in this case, for example, you are already in the profit 40 pips. What you could do is that I'm assuming that your stop loss is currently at break-even point, right, which is your entry point. And what you can do is actually to move your stop loss level 20 pips upwards. So even if price reverse at this point in time, you would have captured 20% of the profit, right? That's better than nothing, better than ending up with a loss of 20 pips. So this is something you can do. But again, a word of caution is that upon adopting this strategy, one common mistake that happens is traders tend to trail their stop loss too closely to the existing price or to the current market price. So what happens is, again, because of the volatility, the prices whip you out of the trade prematurely. Right, so volatility is a key thing to look out for. You don't want to be trailing your stop too closely. Secondly, the word of caution in trailing a stop loss is that actually what happens sometimes is that a deep correction can happen before prices continue to move in your desired direction. So for example, you enter a long trade, prices is about to hit your take profit, it dives down 30 pips. So at this point in time, you're thinking you may never recover the profits. But if you were to leave it be, what you will notice is that sometimes it can continue to move upwards and beyond your take profit point. But if you had set your stop loss too high too quickly, what can happen is that you are taken out by this correction. So this is something to note as well in your post-trade management. Right. So third scenario, right? All conditions has met your trading rule. You feel that you can take a trade, but your profit level has the potential to be better than the risk to reward ratio you have specified. So for example, earlier we mentioned a good benchmark for risk to reward will be 1.5 and above. So you feel before entering this trade that the upward potential is so much more, that the potential for reward is much higher, but you don't exactly know where is it, and you don't want to limit yourself. Right, so what can you do in this instance? So what I would recommend, or a strategy that you can adopt actually, is to throw your stop loss beyond break even into profit, similar to the second strategy. But what's going to happen is that you're going to continue to throw this stop loss each time as price moves further and further into your favor. So it may begin, right, 20 pips into in your favor, you throw the stop loss, you throw a stop loss to your break even. 40 pips, you move upwards by 20 pips, and it continues moving upwards. You continuously move that stop loss point further and further in the green, so that at which point in time prices, if it choose to reverse, which is a natural flow of the market, price will reverse after some point in time, right? At least you have captured the majority or as much profits as you can from that single trade. So this is a tip which you can adopt in your post-trade management. But again, with this comes certain caution. You do not want to be trailing your stop loss too closely, otherwise your trade may be taken out prematurely due to the market volatility. And again, from a deep correction, your trade may also be taken out, and eventually it might move in your favor to your take profit point. So this is something that you should take note of, the three different scenarios which I've provided you with in your post-trade management. So the short answer is yes, there are things you can do after you've placed your trade, and these three things are the example of what you could do, right? So just to give you an overview of how a complete trading plan will look like, is as such. This is a statement that you can do up, write it in your phone, write it in your trading journal or notebook or somewhere you can remember, right? I put in will only risk 1 to 2% of my account balance to enter either a long or short trade with a risk to reward ratio of blank percent. This is up to you, 1.5, 1.6, 2 on the shorter time frame, right? When the price on the longer time frame is above certain exponential moving average. Now, this first part of the statement is establishment of trends. It is the identification of whether you are currently in an uptrend market or a downtrend market, right? Then moving forward, the exponential moving average support has reached or is close to the key support resistance level, right? So this key support resistance level is establishing areas of value and the RSI. So in this case, I've used a technical indicator, right? But chart patterns work as well. For example, and the pennant pattern, price has broken out of the bottom of a pennant pattern, right? Indicating certain conditions. So this is the trigger which you want to specify in your trading plan. And last but not least, this is your post-trade management. Once the trade has moved X amount of pips, I will move my stop loss to break even. Right. So this list is not exhaustive. This is just a sample, a begin, something that you could take to start off with. Of course, as you move along the way, you want to make things slightly more complex. Feel free to do that. But this is simply just a beginner template for you to take reference from to see what your trading plan should look like, a complete trading plan. Right, so now we have come towards the last portion of our presentation where we're going to talk about how can you 10x your speed in identifying chart patterns. Now the thing with chart patterns is that it is so crucial in a trading plan, right? Because as I mentioned, it is the trigger for you to decide whether to enter a trade or not. But the thing is, if I'm looking across different currency pairs, right? For example, in Philip Futures, we offer over 30 currency pairs, right? Over 40 currency pairs. If you were to scan every single one of it and mark out your chart patterns, how long do you think you will eventually take, right? So there is one key concern for people who uses chart patterns as a trigger. How long will you eventually take? So that's the question I want to leave with you. But now, what I want to share with you is that we have officially integrated Philip MT5 with AutoChartist. Now, so what AutoChartist is? It is a automated pattern recognition software. It is the most renowned and most advanced pattern recognition software in the market currently for MetaTrader 5. Right, what it does is that it identifies over hundreds of trading opportunities based on things like chart patterns. If you are slightly more advanced, Fibonacci patterns, key support resistance levels, right? Even key support and resistance levels. So what it does is that it takes the work away from you. It does the heavy lifting. No longer will you have to scan the charts one by one anymore. Upon pulling or using AutoChartist around the clock, what happens is that hundreds of trading opportunities are waiting for you to view. Right? I'll show you slightly later the example of how it looks like. Right? So the third key thing is that it scans the market around the clock. Right, so depending on whichever session you're trading, depending on whether you're a full-time trader or you have a full-time job and you're a part-time trader, you trade after work at in the US session or even the Europe session, you are able to look out for opportunities. There are always patterns being recognized at any point in time, right? And the best part about this is that it can also provide push notification to your mobile phone. I'll move on. All right, so this is how the MT5 plugin looks like. This is the AutoChartist function within our Philip MT5 platform. I have separated it into three main categories. Number one, we have the market scanner. So the market scanner is where, as I've mentioned, contains hundreds over trading opportunities that you can look out for that has been identified for you. One simple one is the triangle you can see in the CAD Yen pair. Bracket daily time frame, there's a triangle that is being identified. Moving further below, dollar HKD, dollar Hong Kong 4-hour time frame, a support is being identified, right? So on and so forth. So right now we are actually in the pound dollar 4-hour time frame chart, right? As seen in the top left hand corner. So as I move to the second panel, the pattern details, you can see that the pattern identified is an ascending triangle, right? So moving below, you see direction, there's an upward arrow. So this tells you the bias of the pattern, whether is it meant to be a bullish bias or a bearish bias. So the rest of the details are not as crucial. You don't have to look at that. Now I'll shift your focus over to the third component of this AutoChartist plugin, which is also one of the most powerful portion, which is the chart projection, right? So other than alerting you or informing you that there is a pattern within this currency pair, what it does is also it projects for you the pattern. It draws out the pattern for you within the charts, all 100 of them, right? So you can observe that the green line and the blue line, these are being plotted by the AutoChartist plugin itself, right? Nothing was done on our end. It was not done manually, but rather the software has plotted it automatically. So beyond that, in the chart projection, you notice blue horizontal lines, right? That says next H4, next H1. Beside them, there are brackets which consist prices. So you might ask, what are they? So what they are actually, they are volatility analysis. So why is this so powerful? You know, earlier when we mentioned your post-trade management, even about setting your stop loss before you enter a trade, what you need to do is to observe what are the possible points where you want to exit the trade. So what do you usually do? You know, for some of us, we set the stop loss based on, again, gut feel, right? Some of us take a more methodical approach. You set it based on previous support resistance, based on previous structure. But again, all of these are just some way to tell you where you would like to exit the trade. But now we have a mathematical calculation for you to tell you in the next 4 hours or the next day, this is the volatility that you can expect from this currency pair. So this has been taken over the period of past 60 days. So how this can be used is that in setting your stop loss, what you want to do is, if you intend to trade longer than the next 4 hours, then your stop loss has to be further than the 4-hour volatility, right? Or the noise is going to take you out of your trade and eventually move in your favor, which is frustrating, right? And if you were to place a trade that is within a couple of days or a day time frame, you will want to set your stop loss beyond the range so that you do not get taken out by the noise. So that is how powerful this tool does, volatility analysis. And of course, I want to move to the last portion of this, which is the gray box that is identified within the chart projection. So you may ask, what exactly is this? So what AutoChartist does is that it also projects the potential take profit area. Right, I repeat again, yes, the potential take profit area where prices can move towards, or where prices or where they project prices will eventually head towards the range it can be. So this can be a benchmark for your take profit region. Right, so this is an extremely powerful tool that traders of all kinds can use, especially technical traders. And even if you're a fundamental trader, you know, having visibility of these confirmation tools is a great way to enhance your trading probability as well. Now, that is not all. I'll move on to the additional benefits. So as I mentioned, AutoChartist comes in a mobile application. So what this helps you to do is that on the go, you're able to view the opportunities using the application on both Android and apps on iOS, right? So it identifies for you the different opportunities which you can then go into your trading terminal to place a trade. Right, so the powerful thing is this, is that based upon your preference, you can also set notifications, push notifications based on the currency pair that you are watching. Right, for example, you are only watching out for the euro dollar, and the euro dollar has a new chart pattern or key support and resistance identified. So this will go ahead and alert you on your mobile phone, just like when you get a hit on WhatsApp or an Instagram update or a Facebook update. Amazing, isn't it? So next we have a risk calculator. So this is especially after we mentioned, you know, you have to take into consideration the risk before you enter your trade, right? Because of the loss of large number, your risk to reward ratio. So this risk calculator, what it does in essence is that it helps you quickly calculate based on your entry and exit points, what is your position sizing that you should take based on your risk profile. So in this example, I've made the choice to say that I would risk $100 in USD per trade. So based on my entry and exit level they have calculated for me, I can only place 0.69 of a lot in order to adhere to my risk strategy. And last but not least, We have daily market reports, which are sent 3 times a day in each trading session. So we begin from the Asian session, then we have the London session, and of course we have the US session, right? In each session, what it covers in the report would be the overview of key news and happenings in the past session. What are some economic data that has been released in the past session, and along with it, 8 different opportunities, trading opportunities or trading chart patterns that they have identified for you in your session so that you may take advantage of it. Now, the thing with AutoChartist is that currently we do have it on the demo and live platform, but only live users are given the entitlement to access up-to-date information, meaning to say the information that demo users have access to is delayed by a day. Even the market reports, they are not entitled to the AutoChartist mobile, and that is something that only live users get to enjoy, right? So after sharing so much today about building your trading plan, about using AutoChartist to supercharge your trading plan, how can you position yourself to take advantage of this, right? So I'd like to share with you how you can gain your edge with trading with Philip MetaTrader 5, right? So first of all, Philip MetaTrader 5 charges 0 commission as you trade. So the only thing that you're paying upon your trade will be spreads, and our spreads are as low as 0.6 pips, right? So 0.6 pips mean it is in the 5th decimal place, right? So that is as low as it gets. You are now able to trade in varying lot sizes, so you can go in steps of 0.01 lot, which is in notional value $1,000, right? So which is why earlier you saw in the risk calculator, you are able to trade weird position sizes like 0.69. So this fully ensures that you can adhere to your risk management and trading strategy. And last but not least, what I've shared in the last couple of slides, trading with AutoChartist, being able to have hundreds of chart patterns at your fingertips in a matter of seconds, right? Not to worry about which session you are trading, always staying up to date with whatever's going on in the market, the opportunities there are, and no longer will you have to spend hours upon hours manually drawing out these specific patterns for you to trade upon. So with that, I would like to encourage you to head over to our website, right? I will encourage you to head over to our website to view all these 3 things: our account opening, our demo account, and also more information on AutoChartist. Last but not least, I want to leave you with a quote by Zig Ziglar, this motivational speaker, that says success occurs when opportunity meets preparation, right? Today we shared a little bit about the preparation portion of things. How do you go about building your trading plan? Now the next thing that is required is for you to take action upon this preparation in which we have done and apply it so that you may experience for yourself how does this work out. Right, so for more details before we end this presentation, I just want to say thank you once again for joining us. If there's anything that you would like to ask us upon further, these are our contact details which you could call for January inquiries. This is our main office address. We are located at Raffles City Shopping Center within the tower. So feel free to go ahead and schedule a one-to-one coaching session with us if you would like to know more about the MT5 platform or the AutoChartist, how you can go about using it. We are glad to give you a demonstration of how you can actually use this. So before I end, if you have any questions at all, do feel free to type it down in the chat. I'll just give it a couple of minutes or seconds to wait for any questions you have to stream in regarding our presentation topic today, and I can cover as much as possible before we end this session. So yes, if you have any questions regarding today's presentation, do feel free to enter it in the chat.
All right, thank you so much, Mr. EJ. Meanwhile, I'm just going to jump in for a short bit. And I just want to let you know, thank you for being a wonderful and attentive audience today. We should be sending an email to send you some details that, the follow-up details that you can have. I'll send you some details with follow-up on what you can do if you are keen to have AutoChartist to support your trading. And meanwhile, if you have any questions, do feel free to type them in the question box, and we will address them as soon as we can. All right, so I hope this has been an informative session for you, and do look out for our next webinar on trading the mini brand, mini dollar index, and mini dollar CNH, featuring our senior analyst from Trading Central, covering the trading ideas for these products. In the meantime, I believe we don't have any questions on hand. Thank you so much, EJ, for sharing those insights with us. Thank you, and have